Investing. If there's one piece of advice that experts always agree on, it's that you should always start now. But it's not always clear what you should be investing in and what investing even is really. Like, what does it mean? Why should you do it? And isn't it just about investing in the stock market? Short answer is no. Investing isn't just about buying stocks. In fact, there are many ways that you can invest your money. This is Find Your Investors. My name's Kylie, and today I'm going to break down some of the most common ways for you to invest your money, plus some of the pros and cons of each investment option. Just a heads up that this is just a brief overview and it's not financial advice. First, back to basics. When it comes to investing your cash, it's just about getting a higher return than what you initially put in. So imagine you loan $10,000 to a friend to start up a business. And then imagine a year later, the business has done really well and your friend gave you back $20,000 as a big thank you. That's a great return on investment. If, on the other hand, the business failed and your friend couldn't afford to pay you back, well, that ends up being a really bad investment, which takes me to my next point. Generally speaking, an investment option with a higher potential rate of return comes with a higher risk, whereas low-risk options also come with a lower potential return. Okay, so I'm going to start off today with one of the safest investment options you can pick from, a savings account. Most people don't think of savings accounts as a type of investment option, but they technically are so long as you're getting some kind of rate of return or an interest. It's just a really low risk, low return investment option. But if you're looking for a safe place to put your money or an emergency fund of some kind, then a high interest savings account is a good option. Savings accounts are safer because usually they're guaranteed by the government. The rate of return you get will vary from bank to bank, so it usually pays to compare your options. And it also comes down to what the official cash rate is. This cash rate is set by the central banks. So if the official cash rate is really low, then overall savings accounts rates will also probably be very low. With the current cash rate at record lows around the world, you can't expect to get more than, say, 2 to 3% from most savings accounts per year. For this reason, whenever you see the official cash rate fall, you often see the stock market rise as some investors choose to take their money out of cash and into the stock market at a higher risk. But if any type of emergency comes up, you have the assurance that you can withdraw your cash at any time and it's going to be the same, if not more, as what you put into it last time. And unfortunately, you can't say the same for the stock market. As a handy tip, if you plan to keep your money in a savings account, just make sure the interest rate is higher than the current rate of inflation. Otherwise, your money will be going backwards. It'll be essentially the same as if you put your money under your bed. For this reason, putting your money under your pillow is not an investment. Your money will become less and less valuable over time as inflation goes up. If you haven't already, before I go on, hit the like and subscribe button to keep up to date with our content. So how do you invest in a savings account? Well, it's pretty obvious. You can sign up online through any bank. A term deposit with a bank is similar to a savings account in that it's very low risk, but it's also less flexible. With a term deposit, you lock in a specific sum of money over a certain period of time, and you also lock in an interest rate. So the interest rate doesn't go up and down like it might with a savings account. So if you're terrible at keeping your fingers out of the cookie jar, this could be a good option because you can't access your money unless you're willing to pay a hefty fine. You'll also have the certainty of knowing exactly how much money you'll have at the end of the term. And it's easy to open one because most banks have them. The downside is that if you need to access your money sooner, you'll usually have to pay some kind of a fine and you might not be able to get the money straight away. Usually banks will offer a higher term deposit interest rate than what savings accounts offer, but that's not always the case. For example, when the official cash rate is really low, banks will sometimes lower their term deposit rates and increase their high interest savings accounts rates to be more competitive. So a lot of the time it might make sense to stick with a high interest savings account over a term deposit. On to my next point, stocks or shares. The stock market is one of the best places to invest your money, especially over the long term. When you buy shares, you're buying a small portion of a company. And if a company does really well, you can expect to see the value of your shares go up over time. In any given year, countless stocks outperform the market average. Tesla grew by nearly 700% just in 2020. Netflix went up by 3,900% in the last decade. For every Tesla moment, there are thousands of stocks that continue to fall every year and countless investors that have lost money on them. So instead of buying a few individual stocks, it's better to invest in a whole collection, a whole diversified portfolio of stocks. If you've got the time and knowledge, you can do this yourself. Your other option is to invest in an investment fund that already holds a big collection of stocks. Just know that while investing in a diversified portfolio of stocks is safer than buying and selling individual stocks, it also lowers your potential return. So how do you invest in stocks? To buy shares, you need to sign up to a stockbroker, and your cheapest option is to go with an online broker. If you're just starting out, make sure to stick to a platform that is good for beginners and not too complicated. Index funds or ETFs? I just mentioned investment funds. Well, one of the most popular types of investment funds is an index fund. You might have heard about these already. A lot of investment advisors point new investors to index funds as a safer option as opposed to buying individual stocks. Index funds track a collection of stocks that are usually used to reflect an entire market. One example of an index fund is the S&P 500 fund, which is a collection of the biggest 500 stocks listed in the United States. So if you invest in an S&P 500 index fund, you're investing in shares from all 500 of those companies. One of the easiest ways to invest in an index fund is through an exchange-traded fund, or ETF. An ETF is just like any other investment fund, except that it's listed on a stock exchange, so you can invest in them in the same way that you would shares, which is through an online broker or a stockbroker. It's worth noting, however, that even though ETFs or index funds are a lot safer than buying individual stocks, they can still be risky because it's still the stock market. For example, if you invest in an index fund just before a stock market crash, you'd see your money potentially halve or worse, and you may have to wait several years or even up to a decade for your money to come back up. On the plus side, so long as the economy continues growing, if you can keep your money in an index fund for at least a decade or 10 years or so, chances are high that you'll get a higher rate of return than if you'd kept your money in a savings account or a term deposit. This makes index funds a better long-term investment. You often hear people say that bonds are a safe type of investment, and that when the future looks uncertain or risky, then bonds are a good place to invest your money. Less often will you hear someone explain exactly what a bond is or how you're supposed to invest in it. When you invest in bonds, you're lending money to a company or a government. In return, you get regular interest payments, which are called coupon payments. If you hold the bond until maturity, you'll get your initial investment back, plus a higher fixed rate of return. Bonds are usually less risky than shares, plus they offer you a stable income stream. The interest might also be higher than what you'd normally get from a savings account or a term deposit. So for this reason, they're a really popular choice among retirees. Probably heard a lot of people talking about diversification. Well, bonds are one way to diversify a portfolio outside of shares and cash. Diversification lowers the risk in a portfolio because no matter what the economy does, some investments or some asset types will always go up and down. You can invest in bonds through an investment fund or through a bond-themed ETF. You can also invest directly in bonds, but you tend to need a high initial investment. So you'll want to hire an investment manager if you're doing it this way. Finally, you can invest in commodities, the most popular being gold. Gold has traditionally been a safe bet for your money during times of crisis because it doesn't tend to see the same kind of volatility that you'd get from the share market. So it's no wonder that gold prices went through the roof in 2020. But there are also plenty of downsides to buying gold, such as the fees that are involved, including dealer premiums, selling costs, storage and insurance costs, and uncertainty over how much it actually appreciates. So while you can hold gold in your hands, it's definitely not risk-free. How do you invest in gold? Well, you can physically walk into a gold dealership and walk away with gold in your pocket. Or often you can have the dealer hold the gold for you in storage, although this usually comes with some kind of a fee. Quick note, property is also a great place to invest your money, but there's way too much in it to fit into this video. We're going to be launching a whole series about property investing, so keep an eye out for that. Really importantly, before you start investing, you'll want to have a plan. Ask yourself, how long can you have your money locked into an investment for? How much risk can you take on? And what do you plan to do with that money at the end? Like if you're planning to invest your money for retirement and you've got several decades, then the stock market can be a great option for your money, but it's also high risk. If you've only got a couple of years and you're saving up for a house deposit with that money, it might be better placed in a savings account or a term deposit. The bottom line is that you need to know what your goals are, and then you can assess your options in line with those goals. Most importantly, the first step is just getting your foot in the door. Just remember, if you want more videos like this, don't forget to like and subscribe. And if you've got any questions or any feedback for this video, don't forget to add your comments in the comments section below.